Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at AlgoBot, and today we're examining an expert advisor called the Fair Value Gap Expansion Breakout. This is a pure price action approach, with no traditional indicators at all. Instead, it reads raw candle geometry to spot a 3-candle imbalance, and then aims to join a strong, expanding move. Over the next several minutes, you'll learn what a fair value gap actually is, how this strategy arms its orders, and how it handles its stop loss and take profit. Just a reminder up front, this is educational information only and not financial advice. Let's get started. Let's start with the big picture. The fair value gap expansion breakout is a price action strategy, which means it does not use moving averages, oscillators, or any classic indicator. Every threshold it cares about is measured by hand from the candles themselves, their highs, their lows, their bodies, and a simple average candle range that is used only to scale its buffers. That average range is not an ATR or any indicator. It's just a plain mean of recent high-to-low distances. So what is a fair value gap? It's a 3-candle imbalance. When a strong middle candle moves so quickly and so far in one direction that the wick of the first candle and the wick of the third candle never overlap, it leaves behind an untraded void on the chart. That void is the footprint of fast, one-sided pressure. Now here's what makes this approach distinctive. Most fair value gap methods wait for price to retrace back into that void before entering. This strategy does the opposite. It refuses to assume a pullback is coming, because in a genuine runaway expansion, the retrace often never arrives. Instead, it tries to join the move only if the move keeps expanding. To do that, the strategy places a resting stop order a small buffer beyond the trio's extreme. The order only becomes active if price pushes to a brand new extreme in the same direction. If price stalls or reverses instead, the order is simply canceled and nothing happens. The gap itself is the thesis, so the protective stop is parked just beyond the gap's far edge. In terms of who this is built for, it suits traders who are curious about modern price action concepts and want to study a momentum continuation style on liquid instruments like major currency pairs, gold, or indices, on time frames from 5 minutes up to 1 hour. As always, remember that trading involves risk, and losses are a normal part of any strategy. Now let's walk through the exact logic, step by step. The strategy evaluates everything once per newly closed bar, so it works with completed candles rather than reacting to every tick of noise. First, it calculates the average candle range over a recent window. This single number scales all of the strategy's distances, so the same settings can adapt across different symbols and time frames. Second, it inspects the 3 most recently closed candles to see whether they form a fair value gap. For a bullish setup, the high of the oldest candle must sit below the low of the newest candle. That non-overlap is the void. For a bearish setup, it's the mirror image. The low of the oldest candle must sit above the high of the newest candle. Third, it checks the middle candle, the displacement candle. Its body must be large relative to the average range, controlled by the minimum displacement factor. This confirms the gap was made by a genuinely strong, decisive move and not by slow, indecisive candles. Fourth, it requires a structure break. The newest candle must close beyond the highest high, or lowest low, of the look-back window just before the trio. This tells the strategy the move isn't just expanding, it's also pushing into fresh territory. Fifth, if all of that lines up and the gap is tall enough to be meaningful, the strategy arms a stop order. For a bullish setup, it places a buy stop a small buffer above the trio's high. For a bearish setup, a sell stop a small buffer below the trio's low. Now for the exits. The protective stop loss is parked just beyond the gap's far origin edge. The idea is structural. If price collapses all the way back and fills the imbalance, the original premise is no longer valid, and the position closes for a defined, structural loss. The take profit is then set a fixed multiple of that stop distance away, controlled by the risk-reward setting. Finally, only one setup is ever live at a time. A resting order is canceled if it ages past the expiry window or the moment price closes back through the gap against it. Once an order fills and becomes an open position, any stray orders are pulled, and the stop loss and take profit manage the rest. Let's read through the code as it appears in MetaEditor. At the top are the input parameters, the dials you can adjust. Lots simply sets the order volume. The minimum gap factor sets how tall the imbalance must be as a fraction of the average candle range. Raise it and you demand bigger, cleaner gaps. The minimum displacement factor controls how large the middle candle's body must be. A higher value insists on a stronger thrust. The entry buffer fraction nudges the stop order slightly beyond the trio extreme so it doesn't sit on the exact tick, while the stop buffer fraction does the same for the protective stop beyond the gap origin. RiskReward sets the take-profit distance as a multiple of the stop distance. Structure lookback is the number of bars whose swing high or low the move must break, and expiry bars cancels an unactivated order after a set number of bars. Now the signal logic. This block handles the bullish case. The first line is the core condition. The oldest candle's high, C1H, must be below the newest candle's low, C3L, which proves the gap exists. The middle candle must close above its open, confirming it's bullish, and the newest candle's close must be above the prior swing high, confirming the structure break. If the gap is tall enough, the entry price is set just above the highest of the trio, the stop loss is placed below the gap origin, and risk is the distance between them. As long as that risk is positive and the entry sits above the current ask, the take profit is computed at the risk-reward multiple, and a buy stop is sent. The bearish side, not shown here, is the exact mirror image. Let's watch this play out on the chart. Because this is a pure price action strategy, there's no oscillator panel below. Instead, the strategy is reading the candles themselves. So I've shaded the fair value gaps directly on price and drawn the swing structure levels as dashed lines. First, the long sequence. Notice the strong bullish displacement candle in the middle of the early trio. It pushes up so quickly that a void opens between the high of the candle before it and the low of the candle after it. That shaded green area is the bullish fair value gap. At the same time, that newest candle closes above the dash structure high, confirming a break of recent structure. The strategy now arms a buy stop just above the trio. On the next candle, price pushes to a fresh new high and the order becomes active at the buy entry marker. Price keeps expanding upward and reaches the take profit marker a fixed reward multiple away. The stop loss, had it been needed, would have rested just below the green gap. Now the short sequence. After the advance, price rolls over. A strong bearish displacement candle appears, and this time the void opens to the downside, shown as the shaded red gap, where the low of the earlier candle sits above the high of the later one. The newest candle closes below the dash structure low, confirming a downside structure break. The strategy arms a sell stop just below the trio. On the following candle, price makes a fresh new low and the sell entry becomes active. Price continues lower into the take profit marker. This is an illustration of the logic only, not a prediction of real results. So that's the fair value gap expansion breakout. We covered what a fair value gap is, why this strategy joins a move only if it keeps expanding rather than waiting for a pullback, and how it confirms a strong displacement candle and a structure break before arming a resting stop order. We also walked through the stop loss beyond the gap origin and the take profit at a fixed reward multiple, and we saw both a long and a short example on the chart. Remember, everything here is educational content only, and not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do happen. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to break down next, and subscribe for more MetaTrader 5 walkthroughs. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.